Evercore ISI out with a new note on Netflix just moments ago, raising the price target to $640 a share from $600. The first firm also raising full-year estimates for 2025. And joining us now is the author of that note, Mark Mahaney from Evercore ISI. Mark, good to see you. So mobile only, a significant factor here, huh?
Yeah, it is. But I think the bigger picture here is you've got this ad-supported plan. It's been rolling out now for a year or two. And I think what it's done is created a lot more incrementality than maybe the market realized. It's broadened the price points, lowered them, so you're bringing more subscribers. We find 40% of people who are signing up for this Save On plan, subscription and ad-supported plan, 40% of them are either new to Netflix or people who churned off in the distant past. So it's expanding the customer range. It's also giving the company something of an anti-churn kind of safety net. It allows them to raise prices at the high end because you've got this kind of lower price option there in case anybody wants to churn because of price sensitivity. Well, there's a lower priced option for you. And third, it gives them pricing power to do that, to kind of stretch the Band-Aid a little bit. There's just a lot of wins behind this ad-supported offering that I think have been underappreciated. It's helped lead to these greater, stronger than expected sub numbers. Paid sharing initiative is also out there. So they got these two nice growth engines. And I think both are working for them well now. It's one of the reasons we continue to like the stock, despite the run-up, even with the run-up.
Netflix's media peers are in a state of upheaval business model-wise. And I wonder, does that end up potentially affecting Netflix's stock eventually because of just how ETFs, passive is working these days? Or is Netflix a port in the storm that's going to end up picking up share and advantage during this time?
I think it's absolutely the latter, John. I think, you had rising competitive intensity in streaming for 2017, 18, 19, and 20, and then it peaked. And when the CEO of Disney got fired for the streaming losses, that was your peak moment. And ever since then, you've had a decline in competitive intensity, which has also shown up in the fact that some of these studios are now willing to sell their content, license their content to Netflix that they weren't willing to do before. That's why Suits, Band of Brothers, and other shows showed up on Netflix last year. That wouldn't have happened in prior years. So Netflix is starting to run away with the categories the wrong way to stay. It's overstatement. But the competitive intensity has clearly come down. There's less money spent on content and customer acquisition, and that benefits the leader in the space. And right now, that's Netflix. And shock of all shocks, they're generating more free cash flow than any of the traditional media companies. So good for them.
Yeah, I mean, it's incredible that that's the case. They've become such a free cash flow generator when a couple of years ago there was a lot of folks just thumbing their nose at the fact that they couldn't seem to find a path towards profitability. Now they're forging the way. I do want to shift gears a little bit because, and I realize you don't cover ByteDance or TikTok, but we did just get this TikTok bill that passed through the House that would basically force, if it were to become law, it would force ByteDance, the Chinese owner of TikTok, to either divest TikTok or basically enact a ban on the apps through app stores. So it's my sense that that now that this has passed the House, that there is increasing potential support within the Senate, that you could maybe perhaps actually see this make it across the finish line. I realize there's a lot of ifs attached to this, but what would it mean for the other social media companies that have been competing so aggressively against TikTok these recent years and that are U.S.-based, don't have ties to a country like China?
Well, I think what the market has been assuming in the last week is this kind of news flow is built up about this potential vote. And now that it passed, is that you may actually, the odds are greater now of TikTok ban than at any point. I have no idea whether it'll go over the finish line or not, but marketers, advertisers, the checks that we've done, they're having to reconsider and come up with plan A, plan B, plan C for what they do with that TikTok spend. That TikTok spend in the U.S. was roughly $5 billion, $6 billion last year, something like that. Now, that's about the size, a little bit bigger than the size of Snap. It's about 15th the size of Meta. But those are the two companies that if you're running social media campaigns, if you're using influencers, and that's a very viable marketing category, and you're going to have to shift away. You'll shift away if you're a marketer and advertiser. So I'm already hearing that campaign. My guess is that if you're considering a major new campaign on TikTok, you're pausing that and you're looking at other channels. It's kind of hard to see why this doesn't benefit Snap and Meta, even if the ban doesn't go through. There's enough uncertainty now. Marketers don't like that. So you'll start seeing a little bit of those budgets move over to both Snap and to Meta.